Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. All right, everybody. Good morning. Welcome back to another live stream. Today we've got a big one. Of course, the CPI report comes out shortly. And the CPI report is a big deal this week. We've talked a lot about it on the streams leading up to this and the videos, just how important this data point could actually be to kind of the stability of the Fed story, right? Of course, the big idea here is that if the Fed's going to cut interest rates, they need to see cooling inflation. They also, there already is mostly some pretty good evidence of cooling inflation, but they're also worried about the tariff uncertainty. But what you definitely don't want to see if you're somebody who wants to see rate cuts, which would boost stocks, gold, other currencies, you would definitely not want to see inflation start to really bottom out and spike higher. So let's just take a look really quick at where inflation is on a historical basis. When I say cooling inflation, this is what I'm referring to. You've had inflation for the last few years, mostly trending lower. In fact, in the last 3 CPI reports, we have underreported expectations, right? So when you have the inflation report coming out each month, there's a forecast, right? So for new fundamentalists, when you see this forecasted number, right, on your Forex Factory or wherever you're looking at this latest report, you can see the forecasted value for the CPI report today is 2.5% year-over-year inflation rate. But we don't know that it's a 100% chance of being the number. The number could actually show up today at 2.3, which would significantly be under what expectations are. And remember, the market is pricing for this. The market thinks that's what we're going to get. So that's how the market positions ahead of time. So if you get a 2.3% surprise, the market has to rapidly reprice based on the inflation data actual number that comes out. This is why you get big spikes when it comes to price data on key economic reports. Deal with China is now sealed, Nick. Yeah, I saw something on here. Our deal with China is done, subject to final approval with President Xi and me. We're getting 55% tariffs. China's getting 10%. So let's just take a quick look in terms of a market reaction. You can see the stock market largely unmoved from that because, right, the reason for that is because the market already saw this coming. That's how smart the market is. The market kind of already has been saying, hey, they're in deals, they're in talks. The market's been trending up before this, assuming, and again, it's all about assumptions in the market, right? The market's always looking at what's happening and looking ahead. The market, I talk about it as if it's this living, breathing thing, but it pretty much is. It's the collective thought of many, many market participants, right? So when we talk about the China deal, the market had already sort of expected that to take place. Now, what the market would not have expected would have been the deals went sour, and then boom, the market would have to reprice lower and could trend lower for a little while. So to me, this is still business as usual. Looks like we're probably headed back to those all-time trading highs. But of course, CPI plays a big note in this. Why does CPI matter so much to this market right now? I'll tell you why. Because if inflation data cools and we get progress on trade deals, the Fed's going to cut interest rates. They're going to bring down borrowing costs, and it's going to be rosy for stocks, in my personal opinion, if you get that combination. If you get trade deals plus disinflation or cooling inflation, right, then you're talking about an environment in which stocks, I think, can do quite well. And so we don't have much of a change on the day to stocks, but you can see things like the Russell have been trending higher. I've been long the Russell. This has been a pretty good trade for me. And you also have gold slightly higher here today. Dollar index is flat. Japanese yen is flat, slightly lower here today. Silver's down a little bit. Look at oil. I didn't miss it, but price was pulling back here yesterday. I was watching for this retest of 64 as a possible buy entry. Didn't quite get it. So I'm going to see if we do get a pullback in the next couple of days. I do like oil on the long side. So how does CPI play into all of this? Well, if you get CPI that comes in higher than expected, that would not be so great. If you got like a 2.6% reading, the expected number today, guys, is 2.5%. So this is what the market thinks that inflation year over year for CPI is likely to come out as today. If we get 2.6%, dollars probably higher. If you get 2.4%, 2.3%, dollars probably lower. If you get hot inflation, stock market might not love that. If you get cool inflation, stock market will definitely like that. So, yeah. A trade deal with China is a big piece of information. Like I said, the reason we're not getting a bigger reaction, in my personal view, is because the market's already been expecting this, right? Things have been going steadily. We've heard many reports before this final deal that things had been going well, right? So that's why the market's already been up. It's great news, but the great news has already been played out for a couple days now, if not weeks. But this is why, that's why you got such a round trip on the NASDAQ. Guys, I cannot tell you how many people were commenting on my channel. Like, the bears came out of the woods. They were loud. They were proud. Stock market's a Ponzi scheme. Trump's going to crash this market. Everything's going to zero. Sell your portfolio. I had one guy on my channel who persistently, this is the epitome. This will stick with me for the rest of my life because this was so perfect, such a perfect example of what people do. I had one guy commenting on almost every single one of my YouTube videos. By the way, he stopped commenting conveniently as the market's gotten back to the highs. Every single day, he would say, sell your stocks, short the market till 2028. Conveniently, that's right at the end of Trump's administration, right? And it was super politicized. And I'm not saying this because I'm a big fan of Trump. What I'm saying is people do this every single time there is a new president. Under Biden, people did the same thing. Oh, Biden's going to ruin the market. You should short the market. You should sell your stocks. And it's so silly to me. The stock market is not completely based on if it's a red or blue president, right? There's great companies in here. Google, Microsoft, Meta. There's some great companies in here. It doesn't matter who the president is. Sure, it does play a role, and fiscal policy can impact markets. I get it. But long-term business cycles, the resiliency of the companies in the S&P 500, these things matter way more than who the president is. And people make these sorts of comments. So I had one person commenting on every single one of my videos, reminding everyone, they should sell their portfolio, come back in 2028. We're not going to see, he kept saying we're not going to see highs until 2028, right? Technically, he could be right because we haven't technically hit a all-time high, but he was saying that over here so loudly, so many times. And I don't know who this person is, right? But he kept saying it over and over, and I kept responding to him in the streams. I was like, dude, are you going to keep commenting if the market rallies? Sure enough, the market rallies, guy's gone, right? That's how this goes. Bears get really loud, and then when the market rallies, those same people zip the lips, throw the key away, they're gone, right? See you next time the market comes down, right? That's pretty much what I think on that. Now, again, there could have been very valid, logical people who were like, I think this market's going to go lower. I'm not teasing or boasting that I was on the right side of this trade just to spite those people. What I'm saying is that there were logical people who got short this market, and then when the market showed signs of turning around, they stopped out and they humbly said, okay, I was wrong about that. Right? So there are different types of people, but a lot of people get so emotionally attached to, I dislike Trump, so this market's going to go down for the next few years, and I'm going to bet the farm doing that. Do you know how many people seriously screwed up their financial journey with this move? A lot. And I'm not cheering that. I'm not celebrating. I'm not saying ha ha ha. I'm saying take that as a warning. If you witnessed that in the comments section, don't let that completely just take that and say, okay, look, I'm never going to be that person. I'm never going to be the person that says, I don't like the president, so I'm going to short the market for the next 4 years. That is just absolutely ridiculous. Again, not a Trump thing, not a Biden thing. People said under Biden too. They said Biden inflation is going to send us to zero. It's silly to behave like that. Trading and investing should not be so politically, emotionally motivated, because again, it will treat you like that guy who's going to, until 2028, if he's short the market, maybe he's right. Maybe I'm wrong for thinking this, but he's been, he was cheering that 2028, at the bottom of the market. Anyways, guys, we've got about 1 minute to go here before we get the CPI report. Going to be really interested to see how this all comes into play. We are expecting, like I said earlier, a 2.5% inflation CPI number. I'll report that number here, but do me a big favor. Don't go anywhere after the report. A lot of people are going to leave right as the number comes out. We're going to do some analysis once this number comes out, and we're going to talk about what kind of trends this sets up for the next few days. So we've got about, let's just see. Got about 30 seconds to go here before we get the inflation number. Let me just tell you about what you're seeing on your screen right now. You've got indices over here. You've got gold, Bitcoin, dollar, oil. So we've got a little bit of everything. This is our all markets view so that you can keep an eye on it. And we are coming in with our breaking news in just a second. All right. Let's see what the CPI number is. Should be in the next few seconds. We'll get it. All right. And immediately indices are higher here. You've got a good sized jump here initially for the indices. Let's just take a look at that number. And there it is, 2.4%, ladies and gentlemen. We will take that. A cooler than expected CPI print. Love to see that. Love to see it. Core CPI dropped. CPI month over month, CPI year over year, everything soft. We will take that every day of the week. Very nice. Russell's absolutely ripping on this. That's great. My Russell trade has become a not too shabby here, I'll tell you that much. Russell's looking great if I just pull that up. So I'm long the Russell. Probably going to trail a stop after this one. Look at this. Coming up into resistance. Beautiful. Beautiful move higher. And this is what we wanted to see, right? So dollar index pushing back towards those lows. I would not be surprised with this print if we go ahead and see the dollar start to break those lows and continue lower. This is suggesting rate cuts to me. And not just to me. Guess who else thinks so? Bond market thinks so. Take a look at the 15-minute chart on the US 10-year dropping precipitously. This is telling you that expectations for rate cuts are increasing, at least at this time. The bond market is saying, oh, we got tariff deals and we got cool inflation. We will take that every day of the week. This looks really good, guys. This is a great this is more good news to add to the pile, right? You're talking about a market that played got you to, I've never seen it play, actually one time I've seen it play got you better than this, and that was 2020. This is one of the best gotcha trades I've ever seen in the markets. This is a V-up move that shocked the world, right? Everybody thought we were going into a tariff-based recession. We still could. I'm not saying like, oh, recession's completely gone, but the probabilities for a recession dramatically decreased. We have inflation cooling. We have deals happening. The economy is showing some signs of cooling off. Don't get me wrong. But if we're going to get some rate cuts to save the day, it's not so bad. Gold's higher on this. Of course, off of a weaker dollar. VIX dropping on this as well. Look at this. Love to see this. Not only are we long the indices, but I'm long specifically the Russell, which is the leader today. Russell's up the most of the group. I know I'm sounding boastful, but I've been on the wrong side of moves. Right now, I happen to be on the really strong right side of the indices. Russell's been bouncing back beautifully. Small cap companies are cheering this because cooling inflation and trade deals means, you know, the Russell, which got hit harder than the other ones, guys. The Russell got hit, you know, very, very hard. A 31% drawdown for the Russell 2000 index compared to, you know, you take a look at the S&P 500, it still got hit, but it was a 21%, right? So to me, the Russell has that room to continue to play catch up. I think that the rally that we could have here is likely to be broad, especially if what's up next around the corner is conversations about deregulation and tax cuts. Again, I think that with the Trump administration, the negatives for the market are tariffs. The positive are tax cuts and less regulation. Those two things are the positives. With every president, there's things that the market likes, things the president and the market doesn't like. But I do think that with the Trump administration's kind of other side of their kind of campaign, now the tariff stuff was part of the campaign, but I think we got a lot more tariff scariness than people had bet on, I guess. But now what we're seeing is trade deals are happening. So now the attention, I think, turns in the second half of this year. This is why I'm still very bullish, where I still think we have upside to the indices at this time, is because, well, here we go. We're charging back to those all-time highs on the NASDAQ. We're charging back to the S&P 500. And now the market is going to start, in my opinion, going to start focusing more on the positives, which is rate rate cuts are a piece of the puzzle. I think we're going to get rate cuts the second half of this year. And at the same time, we're going to start hearing about, you know, less regulation. We're going to hear, and not only that, you know, there was just a little bit of a side piece. I'm a Tesla shareholder. Tesla had some good news over the nighttime trading session with Elon Musk, basically saying he regrets some of the stuff that he said. Unless I dreamed that, but I'm pretty sure I read that when I woke up and I was looking at my news stuff. But Tesla's bounced back really well too. So you have kind of just a slew of good news in terms of the inflation data this morning, trade deals with China. I just want to say too, I know I ranted about, you know, how the bears really got loud over here. Did anybody buy some stocks or indices? Anybody in the chat, let me know. Type me in the chat if you bought some stocks, if you bought some crypto, if you bought some indices, if you bought into the fear that was the April sell-off. Type me in the chat. I'm just curious if, you know, it wasn't easy to do and it was scary, right? It was like everywhere you looked, there was just negative media. If you were getting your feed just from CNN, CNBC, Fox, whatever, it was just ugly out there. Every single day was how we're going into a recession and this is over. And awesome. Good to see that. So yeah, a lot of guys and girls in here bought some Chinese stocks at the bottom. Sebastian, you probably did really well. I bought Google, Meta, Tesla, and AMD. Respect Royal Trades. That is awesome. Yeah, it was Black Friday for stocks. It was. And that's the thing is, you know, that story, how many people capitulated on that and completely messed up? Well, I'll show you. We have percentages for this, right? We have an investor sentiment survey that we can look at and say, what percentage of respondents said they're feeling bearish, bullish, or neutral during that huge sell-off in April? Well, look at what we see. 62% of people, the week that the market was bottoming, at the bottom, 62% of people said they're feeling bearish. 16% more people saying neutral. Only 21.8% of respondents said they felt bullish on the market. Now, why is this important? Well, because this is how markets function. Unfortunately, the markets are designed in such a way, I've noticed this, just I'm sure many of you guys have as well. The markets are almost like designed in a way to take money from the majority of participants and give it to the minority of people who are, you know, willing to take proper risk, not stupid risk, but calculated risk at good times, and to be a bit contrarian in some of the hardest moments to be. So I just, you know, when it comes to that big sell-off in April, if you were on the wrong side of this, I know there's a lot of FOMO out there. I know a lot of people sold their portfolios and are now sitting there and they're like, oh, this just really ruined my year. I totally messed up this year. I got scared, I sold, and then now the markets are back to the all-time highs in a couple weeks. That's insane. Now, if you're on the wrong side of that, let's talk about that. Let's say, what about to the people who did freak out and sell? And maybe you don't like Trump. Maybe, you know, totally valid. 50% of people do like him. 50% of people don't, right? People are going to dislike the guy. People said this under Biden too. Take this as a lesson to say, I'm never going to let, you know, political bias and strong emotional feeling about a particular candidate get me to sell. Because unfortunately, a lot of people did that here, and a lot of people did that in 2022 with Biden. A lot of people said the president's going to ruin us. I'm shorting everything. I'm selling all my shares, so on and so forth. Don't be that person. Just be careful not to let that. And if you did, don't beat yourself up about this. If you're like, dang, I completely screwed this up. Don't say to yourself, like, angrily with tears in your eyes, you know, I hate this market. Don't be bitter about it. Just learn from it, because it's going to happen again. And we're going to be here doing the same thing that we do every single day, staying on track and not letting that completely blindside us. Okay. By the way, guys, if you do want to keep up with the trades that I'm taking, this Russell trade is absolutely killing it now. 1.5%. This trade has really gone super well. We're sitting at a big level of resistance now. I didn't think we'd get up here so fast, but with the cool inflation print, I guess it makes sense. 2.4% inflation compared to the 2.5% expected. That is cooler than expected inflation. And the Russell, which is a collection of small cap companies, love the idea of lower borrowing rates, right? Smaller companies who are more interested, they're trying to grow quicker. They're not your ginormous Apples and Amazons, right? These smaller companies, they rely more on borrowing costs. If you've been listening to my videos, then you know that I've been in the camp of thinking, I think the Fed should cut interest rates. I don't, you know, I'm not going to disrespect or call Powell names. I definitely don't agree with that. But I do think that in some ways, there is a strong argument now for rate cuts. We had an NFP report that was a narrow beat, revisions lower for the last 4 months. We see the labor market showing some signs of cooling. And now we have signs of inflation cooling as well. I mean, we've had inflation cooling. We had more evidence of that today. Inflation cooling, labor market is showing some signs of cracking, or at least cooling off. I think it's time to cut interest rates. And with tariff deals happening with China, it's time to cut rates, in my personal opinion. So to me, that would signal that things like Russell, which is an index that is very sensitive to interest rates, as it directly impacts their net profit margins, because, of course, their borrowing rate, their expense that they pay in interest is very directly hit by that, because these companies, small cap companies, they borrow money, right, to grow. So these companies would do very well, or would do better as a group, if borrowing costs went down. Borrowing costs are interest rates. So I think interest rate cuts are coming. And so that's why I remain long the Russell, right? Now, of course, I still have lots of, you know, big tech stocks. I own Google, I own Tesla, I own Nvidia, Apple, Amazon. I own all the big ones because of the buying that we did back in March and April, March and April. But from a trading perspective, I like the Russell. So we're sitting at resistance. I'd love to see a breakout through these highs. If we get a decisive close above this, I'm going to take my stop and trail it further into profit. But that is the full breakdown. Thanks, Peter. I appreciate that. Gold and silver, please. I'll take a look at gold and silver in just a second here. Let me just pull up our lineup. Just a quick heads up. If you're new to the show, we do this Monday through Friday. And if you're new, highly recommended that you subscribe and turn on post notifications. We are here live, like I said, Monday through Friday. We report all of the major economic data. I'm just going to pull up really quick on the A1 Trading website. Head over to a1trading.com. Under your A1 live stream here, you can see the schedule for the stream. We have several people who come on and share ideas. So we have Forex James coming on here in just a few minutes. I'm going to do a quick look at gold and silver, and then we'll move on to Forex James joining the call here for our Wednesday session. Okay, so how does this impact gold and silver? Well, to me, gold looks really good because now you have cooling inflation. I mean, you already had cooling inflation, but now you have more evidence of inflation cooling here in the US. The Fed, in my opinion, has multiple reasons to cut interest rates. I think that you have good reasoning here for the Fed to cut rates. Now, we can go through the list, but I'll give you just the high level, really quick summary. The US dollar impact that you see right here, guys, on our heat map, this is a software that tracks all the major economic data points and generates a bullish or bearish bias on the US dollar and stocks. That's the simplified version of what we're about to talk about. On a high level note, PMI data is weak right now. We had below 50, which shows contraction in the economy expected by hiring managers and decision makers within the economy. There's an average surveyed response telling us they think contraction is coming based on their metrics. You know, if you ask somebody who has a lot of hiring and firing decisions at Walmart what they see coming, that's insightful stuff. So if you did that across the whole economy, PMIs are suggesting some weakness here coming. So if you have weakness expected there, if you have jobless claims that came in worse than expected for 2 weeks in a row, if you had ADP, which came in really rough, you know, the point is here, you have a lot of our metrics suggesting, and we'll get the inflation numbers to update here, more suggestions here that, you know, CPI was bearish for the US dollar. To me, the path of least resistance for the US dollar at this time is still negative, right? So that could that change at some point? Sure. But with the dollar heading lower right now, trending on the higher time frame to the downside, we're sitting at a level of support. I would not be surprised if we do take out those lows and continue to move lower based on what we've got today, more evidence of cooling inflation, etc. So for gold, that to me would suggest path of least resistance is to put in new highs for gold. So what I'd be looking for would be a breakout of this level, pullbacks into this support and continuations, or a pullback into some of the previous support and this upward trend line that we've watched on the channel for some time. So I'm looking at pullbacks to 32.40 or break and retests at 34.40. Both of those are possible setups for me on gold for possible longs at this time. Silver also looks amazing. Pretty obvious area of interest here for me would be a pullback to these previous highs. So if you do get that pullback, to me, maybe some bullish setups at that time. Again, I think rate cuts are coming. That gives me a baseline in order to look at all markets, right? The beauty of trading as a fundamentalist and not necessarily, oh, I only trade gold or I only trade euro. As a fundamentalist, I can trade a whole bunch of stuff. I can look at currencies on this this way of thinking. I can look at silver and gold. I can look at indices, bonds, etc., just based around, again, the economic data and understanding what it's telling me. If you want to try out the Edge Finder, head over to a1trading.com/edgefinder, or we'll drop the link to try out the tool for 30 days if that's something that you're interested in signing up for. Additionally, if you'd like to get access to our trade alerts, they're currently 45% off. It's the biggest discount that we do all year long. If you'd like to get 45% off the VIP group, here's how you can do so. We'll drop a second link here in the chat right now to where you can speak directly to our support team. Click that link. Just let us know you saw on the stream that you can get 45% off our VIP group. Again, within the group, you get to see every trade that I am taking, right? So any index trades that I take, Forex trades, etc., all of them are available to members. If that's something that would be beneficial to you to get notified anytime I take a position and where I entered, where I exit, etc., click the link in the chat, send us a direct message, or head over to a1trading.com/VIP. Okay, guys, up next, we got Forex James joining the call to take a look at some markets with me here this morning. Stay tuned. If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show. All right, and we are back with Forex James. Give me 1 second. I'm behind this thing. I'll be there. I am. How's it going, man? Good to have you back on the show.
Cool. Yeah, I'm good. Thank you. How are you?
I'm good, and I'm curious as we get started here. We had a cooler than expected inflation print. This past week, we had a good bit of labor data out of the United States that was a little bit soft. I'm curious. You're primarily on the FX side of things. What are you watching right now? What are your thoughts on all this?
Yeah, so I've taken a bit of a rotation in terms of positioning, actually. So I'm in a Euro Swiss long. I'm anticipating a switch or a continued risk on move, and that was mainly derived from the indices market. So we've had the DAX print new all-time highs. We've got the US markets that have had incredible recoveries, which to me tells me that there is risk appetite back in the markets. So I'm quite happy to see the Swiss come lower, see euro inflows continue. I'm short on the dollar, actually, which I'll go into in a second. I'm in a pound yen long. Similar reason, I'm quite happy with the situation of pounds in. We had pretty weak data for the UK labour market. I think it was yesterday, but I just used that for an opportunity to get in because I like the UK landscape a lot better than the yen at the moment. And I'm in a Swiss yen long, and I'm still in the short position as well, which, again, I can elaborate on shortly. So the US dollar puts me in a tricky position because I don't like to be a bear on the dollar. It's the world reserve currency. It's a powerhouse of the global economy. I find it very difficult to sit here and say, or to be a doomer and say, the dollar's going down to wherever, 80, 70, whatever. So I'm not doing anything on the dollar right now because we just had, we had about 40 minutes ago, Trump tweeted that the deal with China's done, which reinforces the taco statement because he's gone from 145% tariffs. There's now 10% on China. So we've got a little bit of clarity there at least. So I'm just waiting to see what happens in sort of this $90 range. Do we remain in this channel? Because over the past 17 years, this same sort of cycle or same pattern has just been repeating where we have the pump to the upside range. You could doom a moment upsides, and then we pop to the upside, create new highs. And then again, we just sort of range and then pop again. So I'm just waiting to see, is this the same pattern where we're now just sideways in the grand scheme of things, obviously the weekly time frame, before we have another pop to the upside. However, the reason I'm short at the moment is because, as you said, we've got pretty weak data for the dollar, and I'm not going to try and fight data. So I'm in a short or a low risk position, short on dollar Swiss at the moment, just looking to see if CPI is going to be a catalyst to bring some more bears into the market.
Sure. Yeah, I think your concept about like the long-term trend of the US dollar, I definitely feel, similarly in terms of like the long-term momentum of the US dollar over the last, since 2008 or whatever, has been for the most part to the upside. And we've seen outperformance in US assets pretty dramatically during that period of time, right? You saw US stocks are still, I would say, the cream of the crop, the best place to be in terms of equities markets, which do play into the currencies world as well, right? Because if you want to buy US stocks or US bonds, what do you have to buy them in? You have to buy them in US dollars. So creates that demand for the currency. I think also, right now, to your point about the announcement with China and the US, I do think that on a long-term basis, we can look at that and say, that still centralizes the US dollar in global trade, right? If trade deals are going well, that is, in my view, a long-term still a strong thing for the US dollar. I think right now we are probably seeing evidence, as you got, you're also on the bearish side of the US dollar in the short run. I think right now what we're probably seeing is the cards fall in a way that it suggests the Fed is likely to cut interest rates this year, and that could lead to a leg lower in the U.S. dollar. But I'm not necessarily like you said, a doomsdayer in terms of the U.S. dollar, where I think the U.S. is going to fall out of favor globally, and it's no longer going to be the reserve currency. I think that if you're talking about that, you're talking about gold. I'm also not making the forecast that I think gold's going to go to 5,000, right? That would be the same kind of narrative of like de-dollarization globally, and the dollar's going to crater, and it's all going to zero. That would be where maybe the way to play that, if you truly had a de-dollarization perspective, you probably are somebody who buys a lot of gold, right? Because that's like the ultimate kind of thing there. But if you're talking about just a trend in terms of general strength based on interest rates and things like that, I think that the likely path of the dollar is still lower at this time. What do you think if you were to trade? So you've got dollar Swiss positions. If you had any other ones to add to the list, what other trades, if you had to take another one on the US dollar, what would your second pair be?
That's a good question. It probably would be gold or silver. I really like the idea of silver at the moment to the upside.
Yeah.
I'm watching to see if we can have some sort of pullback into the previous highs, and obviously just form a very basic break and retest. Gold, I was actually a bit of a bear on gold temporarily, but I'm finding it difficult as well to really have a strong bias either way. Dollar CAD, I also really like the trend on dollar CAD. I think this has been a very easy market to sort of sell and forget, really. So if we do see the dollar start to break these weekly levels, dollar CAD might be one that I would wait for a pullback and then go short, and again sort of just hold it into the 1.35 level.
Yeah, I like that on the dollar CAD. On my screen here for just a second, I've got the economic surprise meter pulled up. And what I think is really cool about the surprise meter is that if we're looking at this and we say, okay, the state of all the different currencies relative to their forecast, and that's what really matters, right? So when we talk about like, is the US dollar crashing, we're not necessarily saying, when I suggest like I'm bearish on the dollar, I'm not saying it's like structurally going to zero or anything like that. I'm just saying that recently the data has been falling weak. That does not make me to your point, like I probably am, I've definitely taken way more bullish long-term, positioning on the dollar than I have bearish. But right now, the data is falling in a way where we've pretty much consistently been seeing most of our data prints soft for the US dollar, not supporting strength, but supporting weakness. However, to your point about like Canadian dollar, I definitely was going to say for me, it would probably be, if I was to go short the dollar as a baseline, what do I want to get long against it? It would probably be the Canadian dollar, the British pound, or the New Zealand dollar. And again, does this say that I think that the British pound is just the better economy for the next 10 years? No, this is a trade, right? I'm just saying right now, economic data has been pretty upbeat for the UK, pretty upbeat for New Zealand, pretty upbeat for Canada. And I'm not sitting here and saying like, these are my long-term 10-year positions. These are just trades that I'm in right now. I'm saying, okay, I think the Canadian dollar could outperform, the New Zealand dollar could outperform the British pound based on, data points coming in higher than expected. I think you mentioned a little bit of wasn't even really that much weakness on the UK recently. We had the unemployment rate did tick higher from 4.5% up to 4.6%. That being said, that was pretty much what was expected. So even there, it was kind of a neutral impact to the British pound. Services PMI were better than expected. We've had inflation prints that have been high for the UK, suggesting the Bank of England may not cut rates as fast. So yeah, I think that right now, the British pound, like I said, not my favorite economy to invest in. I'm not investing long-term in a bunch of UK stocks, for example, but I do think that right now the British pound has potentially a bit of outperformance to do, as it's already been kind of doing that, right? This has been a theme for a little bit here, has been stronger than expected economic data for the British pound. And then things like the euro, I'm just very mixed on, right? Euro is if I go to the EU economic heat map, I could repeat this process, and you can see that on this front, euro impact is pretty neutral. We've had some positives, some negatives, so probably just not a lot of trades there on the euro for me at this time. So I've actually taken the euro short against the British pound, just in neutral on the euro, but then more bullish on the British pound. So just because I liked the technical setup on that one. Any other what? So I liked I too also really like silver on a pullback if you can get it. This looked really well, or like looks really strong here. That huge breakout. Any other charts that you're watching?
Well, yeah, euro pound, as you said, I've still not managed to get into the. It came into the area where I wanted to sell initially, but that was right after we had the UK news yesterday. So I was just holding fire a little bit.
Yeah.
And yeah, it looks like it's creeping higher, so I might be able to get an entry at some point. But yeah, I'm not quite in it yet. I mean, I say this all the time, but the technicals or the typical price action on euro pound, I find it very difficult to find a good entry with a reasonable stop loss because it can be so choppy at times and it can be very volatile very quickly. So yeah, I'm just trying to figure out and just playing it very patient in terms of where do I want to get in on that market. But it will be one I'm looking to take in the near future. Euro dollar, pound dollar, potentially I'd like to go long, but I'm not really too interested, to be quite honest with you. Dollar yen is also one I was considering going short on. And this one will be more just to offset my my dollar Swiss short position. So we've got MUFG that's got a sell limit. So this is the MUFG position 1-to-1. So I've not set this yet, as in terms I've not set the pending order for this trade yet. But
James, what is MUFG? What does that mean?
Oh, MUFG is an institution, so they do research and trading.
Okay, gotcha.
So if we do start climbing higher and create some sort of double top here, see a rejection, maybe some positive news for the dollar, some sort of catalyst, some negative news for the dollar, then maybe I'll go short, or some positive news for the yen, whatever it may be. That's something I'm considering. But yeah, the main trades I'm in are actually the ones I'm most confident in at the moment. So yeah, I'm just going to let these ones run. I'm not desperate to get into anything else just yet.
Yeah, fair enough. I'll share my thoughts on euro pound too, just because you shared yours. So euro pound for me, I have a short position on. It is I got in over here. So I initially was in the green, I guess, in the blue, and then has backed up, started going back against me. But I do have these levels marked out. So what I love about euro pound is the same thing that can be frustrating to some. It's choppy nature. It's very back and forth for the most part. So I'm actually looking to build, if I can, a bigger short position on the euro pound if we see these levels kind of get hit. So I've got 85.20, I've got 86.20, 86.80, let's call it. These would be levels that I'd be willing to actually add to a short position, which I know sounds kind of crazy to people who are new to dollar cost averaging. They're like, what are you talking about? You would add to a loser. But the way I see it is I generally think that the euro, that there's some good premium selling opportunity between this range, right? I'm not necessarily pinpointing that I need to be right here and it has to keep going. You can do that. And I think that the beauty of having different trading styles is that you could take a trade and say, I think it's going to go lower here and put a stop loss here. And that's one way to play it. But for me personally, I'm a little bit more longer term in nature and not super particular when it comes to the Forex side of things on being right away or just going to get stopped out otherwise, right? So I'll take a short position here. I'll take another small one there, another one small one here, another one small one here. And if this thing ran through all of those levels, you might say, well, then you're going to blow up, right? Nope, not even close. The positions are so small that I could see it go way beyond these levels and it would not even put my account in jeopardy at all. So the sizing is so tiny that I'm not even worried about that. So again, do it. I don't care. I'll just add into the position because I think that this is a premium to potentially sell the euro by the pound. As long as that continues to be the case within the system that I'm using, the surprise meter, looking at generally the economies compared to one another, as long as there's generally a better outlook or better picture for the British pound, I'd be happy to continue to work with that position. And if I'm wrong, then I just look to close out at a reasonable spot and just move on and do the next one. So it's a different style than what a lot of traders may be used to or may like to do. And to be completely fair, you can get yourself in a lot of trouble if your position sizing is big. But if it's tiny enough, you can just have very high, consistent, high win rates, even though you're going to sit in drawdown sometime. Like I have a CAD Swiss position that I've been sitting in drawdown for like I don't know, probably 2 months. I bought some CAD Swiss over here. I bought some more CAD Swiss over here, and I'm like around break even. I've been sitting in it for like a month and a half. It's just been going nowhere. Collecting positive swaps on my 2 positions, but yeah, just the pros and cons of dollar cost averaging.
Yeah, well, that's the beauty of euro pound specifically, is because they're correlated. Even if you do have a large swing, generally you will have a reversion at some point. We both said it many times, but it could take days, it could take weeks, but generally, historically, we do see a nice mean reversion on euro pound. So as long as you said, positioning is reasonable and you can hold it, then it should, I say should loosely, work out in the long term.
Yeah, no, that's a good point about, when you think about economies that are very, very different or very, very similar, they're typically going to be, for the most part, their charts are going to be more sideways. So if we take, for example, the Australian dollar versus the New Zealand dollar and just look at this, you can see that this currency pair mostly goes sideways because they're both Pacific-based economies. They do a lot of raw materials trading with China. Their economies are similar. Their cultures are similar. They're not the same, obviously, but the point is they're generally going to move, not guaranteed, not certainly, and there are times where this correlation breaks down. But by being someone who trades mean reversion on the Australian dollar against the Kiwi dollar or the euro versus the British pound, you're sort of trading a correlation trade. And that is why I actually love trading those currency pairs, where a lot of people dislike these because they don't trend very well. I like them because they don't trend very well.
Yeah, it's essentially just range trading, really, isn't it, on a high time frame?
Yeah, exactly. So, different ways to do different things in terms of all of that. So, what else, James? Are you looking at any commodities other than do you ever trade oil?
I used to, but I'll be honest, it wasn't something that I really did anything on. I used to pay attention to it, but I focus mainly on FX, and I spend most of my time researching FX. So even the Canadian dollar, I don't really trade it because I don't pay attention to oil enough to the point where I feel like I'm confident enough to trade CAD. But yeah, no, I like to look at the technicals, and I might take, if there's something that I see that's really convincing on technical aspects, and I see something, whether it be OPEC related or whatever it may be, I'll take a low risk position now and again. But it's not part of like my main basket of trading assets. Yeah, the one for me that's always, I have to double, triple check when I place trades on it is any yen pairs, because yen pairs, to what I just got done discussing about why I like things like euro pound and the Australian Kiwi dollar, like I feel like those stay in a pretty tight box. The yen is not the way, not the same. It trends very aggressively. And this is why, for the FX traders, you've got to be pretty selective with what your style is, what your back testing tells you, etc. Like if you're somebody who trades trend following systems in FX, you probably want to look closer at currency pairs that tend to trend, like the US dollar against the Japanese yen, the British pound. What are your thoughts on that, James? Like in terms of choosing the right currency pairs for different strategies? Yeah, no, I completely agree. I think I think you might have said it before. I'm not 100% sure who it was. But markets are very much like people. I think you said they were like breathing, living organisms in a way that they all have their own behaviors and their own traits. And there are strategies that work better or generally work better. So again, euro pound works better in my view with a DCA sort of mean reversion strategy.
Yep.
Whereas, as you said, dollar yen is more of a trend following, or ideally a trend following strategy. So I'm not in the agreement that trading one asset is a good idea, because I know that's a big thing in especially retail Twitter is trade one thing, one pair, one time frame. I don't agree with that, but I do think you need to understand what pairs or what assets work best with your trading style, and understanding why those assets work well. So, for example, the correlation between Europe and the UK and Australia and New Zealand. But if you don't, if you're not paying attention to not just if they work, but why they work, you're going to get a little bit lost. Because it's easy to transfer a strategy to something and it work for a week or work for 2 weeks, and then it will collapse because that's not the general market dynamics. You could have got a very off cycle, for example. I'm not sure if that actually makes sense of what I'm saying, but it makes sense in my head.
No, it does make sense. There are times where, if you're somebody who says, I only trade gold, that's like probably the most common one that I always hear is like, I only trade gold. It's all I trade. And if you're like a scalper, then I understand. Like if you trade like the 5-minute chart and you're like, there's always setups happening on gold and that's your thing, then by all means do your thing. But if you trade 4-hour charts, if you trade 1-hour charts, if you're more of a swing trader, I think you can really get yourself in some trouble staring at a very, very slim list of things that you can trade. Because what's going to happen is you're going to get bored and you're going to start placing trades that you shouldn't be placing because you have nothing to look at. I mean, as traders, we do need to be placing trades. Like you can't just not trade for months on end. I mean, I guess you could theoretically, but if you're trying to, be active and perform and outperform the passive index, you probably do want to have opportunities setting up. You don't need to be taking 50 trades a day, but we still want to be finding opportunities that produce some positive great risk reward setups that can generate some income, right? That's the idea of trading. We don't need to be in them all the time, but you want to have a list of stuff that you're familiar and comfortable with trading so that your opportunities list is more diverse and you can really pick the cream of the crop. If you're only looking at one chart and it's like, this is an okay setup, but I see a great setup over here, but I'm just not going to trade it because I don't trade those things. You could be cutting yourself short by not broadening what you're looking at. Now, I do encourage, if you're gonna add another chart, Marco, who comes on our show pretty frequently, he talks about this at length. Over time, he's come on our show and talked about how he's literally been like, I'm going to back test this currency pair aggressively for the next few weeks, and I'll let you know if I add it to my roster. And I'm like, that's how it's done. Like people who are doing that, who are saying like, give me a few weeks, I'm going to go see if I can add gold to my list of tradable assets. That is how that is done. So for people who are listening who are like, oh, I only trade gold, but I know what you're saying. Like I should probably add a list of possible setups to my list, especially if you're a 4-hour daily chart trader. Take the Marco approach, which is say for the next 2 weeks, I'm going to backtest the heck out of, pound yen and see if it fits with my criteria. And if it fits your criteria, and you've done the research, then hey, look, you've got another thing that you can relatively confidently, maybe slow at first, but you can add it to your mix of tradable assets.
Yeah, I completely agree. There's a guy, and I'm not trying to name drop, but I think you know who he is. It's Sam. He runs KB Trading.
Yeah,
he's quite frequent on social media. He has a very interesting trading approach because from what I understand, he's more of a statistical and probabilities-based trader. Mm-hmm. So he goes and back tests, days and hours and certain points in time. Then he'll refine it. Then he'll back test again a specific entry model around that time frame, and he'll have hundreds, if not thousands, of data points to back up whether it works or not. But it's almost the opposite of what me and you do in terms of we're looking at what's actually driving the markets.
Yep.
Rather than it's 9 times out of 20 this would happen, so I would avoid it. Or after a bullish candle on a Tuesday London Open, I'm going to get stopped out because that generally is followed by whatever it may be. So there's lots of different approaches to trading. So it's about, in my view, it's just about finding not just what works for you, but also what you enjoy doing. So for me, sat there, journaling thousands of things in Excel and backtesting for hours on end, that's not something I want to do. So I'm going to try to avoid that and see what else I can find that works. But some people may enjoy that. There are people that enjoy collecting data and analyzing all that type of things. So yeah, it's about just finding your groove, really.
What it sounds like you're talking about, James, is the age-old question, and I'm gonna spoiler alert. I think the answer is both answers can be correct. Is trading more of a science or more of an art, right? And so when you talk about Sam KB, who friend of the channel, and I've had him on for interviews several different times, and I highly respect his scientific approach to trading. Right, he's very, very, as you said, he's very quantitative. He's very, he's carving through data to find setups. Here's the thing: for everybody who thinks that they're just a pure technical trader, it drives me insane because they don't actually do back testing. Like that is the most like frustrating thing for me ever. Is there's so many traders who are like, I watched a few YouTube videos on some smart money concepts or some simple technical strategy that makes you 75 pips a day. Like they see those things, they watch a few videos, and they just start trading it on a live account, and they think they're a technical only trader that's like going to make it. And that drives me absolutely insane, because I know many traders who are fundamentalists and who are technical kind of focused, right? There's fundamental focused traders that I know that have done well. There's technical only traders that I know have done well. But what drives me insane is that the technical only traders get absolutely, and Sam KB would say the same. I know he would, in terms of how maddening that is when people don't actually do any of the research. They don't do any actually of that heavy lifting, hard work, scientific method approach to trading, and call themselves, like, I'm an ICT trader. Well, have you actually poured through the data? Have you actually tested that entry 10,000 times to see the probabilities of it working on a specific time frame, on a specific chart? And I've done that. I've done both. I've done the heavy scientific method. My background is in computer science, so I spent years writing code for robots and throwing it against MetaTrader 4 and MetaTrader 5 data, pouring through statistical results on strategies. And I can respect that approach, and had found ways to make money doing that approach. And I've also approached it the more art way, which is understanding, trying to pull together. And I say art because when you're a fundamentalist, you do, to a degree, have to take into account many different variables that you couldn't possibly quantify perfectly if you're going to take into account everything, right? You can't quantify Trump tweets and backtest them 10,000 times every time, but you can know that that's likely going to cause some volatility, right? So it's a bit of both, in my opinion. It is a bit of a art and a science. But again, if you are a technicals only trader and you haven't spent 10,000 hours back testing and pouring through data, you're not a technical only trader. You haven't put in the work like that. It is so grindy to find technical only edges in the market. They do exist, but ask Sam KB, go follow him on Twitter and ask him how easy it was to find edges, and he will tell you.
Yeah, absolutely. I think it really comes down to knowing what you're relying on. So, for example, I don't rely on technicals to make my trades work. I just use them as a point to enter, and that's as simple as it is. I'm not getting any direction or any confluence really from the technicals. So my strategy, especially my swing strategy, relies on the economics and knowing that I'm in the same flow. Obviously the trade might get stopped out, but as far as I'm aware, I'm in the same direction. I'm in the flow, and that's what it is. But if you are a technical trader and you stick a moving average on an RSI, you can't really rely on that unless you've got the data. You could say after, a 2% move back to a 200 moving average, the RSI comes to at least 60. Then 20% of the time it continues higher, 80% of the time it will revert back by 3%. Obviously, that's an example. Don't take that for gospel, but you've got to have something that is going to keep you glued to the strategy. Because I think I'm going off on a bit of a tangent here, I do apologize, but I think one thing that makes a lot of new traders jump from strategy to strategy is because they don't have the data to say if it works or not. So as soon as they have 2 or 3, 4 losses, they think the whole thing doesn't work because they've got nothing to compare those results to. But yeah, I mean, yeah.
No, what you're saying is like the most frustrating thing about it all is that a lot of traders, they think that they've done the work, and they think that trading is easy because they haven't actually, like, to me, I'm such a proponent of doing the back testing thing because it absolutely humbled me to smithereens when I spent the time necessary to back test. Because, I've told this story many times, James, but basically in college, I wanted to build a trading robot. my background in computer science. I wanted to build trading robots. I wanted to build a system that would generate, I was looking to try and make 50, 60, 70% per year. And, I was like, is this possible to do? Let me see if I can prove it by building systems that have been able to do that. And I could not. If I wound back my back testing systems, build anything I could possibly think of. I built probably 200 different expert advisors with like detailed code on entries, exits, based on YouTube videos that I'd find, based on strategies. And I could find what I found through doing that process was, okay, wait a second. So every time I try and get a system that makes 30%, 40%, 50% per year, consistently every year, every time I would build a system that would do that, and I'm trying everything we can think of here to build a system, it would do, some years it would do phenomenal. And sometimes it would even do years, like 3 years in a row, where it would make 30, 40, 50% per year and just do incredible. But then on that fourth year, or that seventh year, or that second year, when I would run a back test, these things would blow up eventually because the sizing was the problem. And so that is why I'm such a big proponent of small position sizing, is because it doesn't, like, I would take those same strategies and dial down the risk tolerance so much. And guess what? Those same systems would work great over the long term. So to me, it was like that realization. First, it humbled me tremendously because I was like, dang, trading is not worth it unless you have, millions of dollars if you can only make, 20% per year. That was genuinely my thought, like many people comment on our videos nowadays. But at first that was a bummer. And then later I was like, wait, if you actually start plugging in what 20% per year does for you over a course of a 40-year trading career, you can be incredibly wealthy. So once I embraced slow and steady, patience wins the race, I realized that's what all the pros are doing. They're not looking to make 80%, 90% every year, because that's a fallacy that makes people blow up trading accounts.
Yeah, no, I completely agree. I mean, I think the ability to sit through drawdown is a skill in itself. I mean, I told you when you came onto my stream when I did the 24-hour one, I told you I was down 7% on the year. I brought that back a little bit this week, but I'm still in some drawdown for the year. But it doesn't bother me, I'm not really that concerned about it. It is what it is. So the ability to have, we're 6 months into the year and I've not really made anything on the account that I'm trading on, because it's just a bad year and it is what it is. And this is one of those things why it's important to, I say this quite often, I think you say it as well, to have something else aside from trading. Because if you rely on trading on its own, and I was going through this where I've had pretty flat 6 months. It's been up and down. I had a couple of months in profit, then it came down again. So I made a little bit, but it wasn't anything impressive.
Yep.
But if I didn't have other sources of income, it would have been a nightmare. I'd have been really, really panicking. So there's that. But yeah, I think there's lots of different components within yourself that come into play with trading. It's patience to do the testing and figure out what works, and there's obviously drawdown tolerance. There's being able to not get FOMO, not get greed. There's so many different things that you need to be able to be on top of. So yeah, it can be tricky.
No, and that's the thing too, is I'm a really big proponent of having other things, not only to keep yourself to keep your income diversified, but also to keep your mind active in other places. Because drawdown years they happen. Like this year's not a drawdown year for me, but I've had years like 2022 was a year where I was in drawdown across most of my trading accounts, and it really, really stunk. Like it was not fun, painful, frustrating. Nothing seemed to, like, I would get some wins going and then would give back those gains, and it was like I just kept resetting my year, and I had a negative year, and so it was painful. So the thing is, those years are going to happen, and it's hard to, on paper, you're like, those things are inevitable, but when they actually start happening, it's like, this is really hard. It's really mentally painful. You're like, I want to be up. I want to be, generating income. I see other people generating income in the markets. But at the end of the day, just objectively, every system is going to have drawdown periods, and it's not out of the question. It's even normal to have drawdown years, or a year, I would say. I've never had a 2 years back to back, but I imagine it's possible too. So having other sources of income, having other things to do, is a really important component to just the longevity of this stuff. So you don't drive yourself insane in a year where things are just not going super well, and your system, you still trust in your systems. Like you said, you're experiencing drawdown. You're not too worked up about it, but it's still not fun to wait. But it's like, okay, if I have other things that I can be doing, I can focus on, in our case, content creation. We can work in other avenues, other things that we can be doing that can help to distract. For other people, it might be, they have a day job or a part-time job, or they have kids. They can go spend more time with their kids, like do other things, right, to distract you from staring at your chart and saying, I want to be out of this drawdown right now. I'm going to force getting. That's how you get yourself into a lot of trouble. Is like, if you're in a drawdown, you're like, I don't want to be in a drawdown anymore, and I'm gonna go all in basically to fix it, and that can lead you into some really, really dark places. So definitely, like you said, you're sitting at a 7% drawdown, or you were sitting at a 7% drawdown.
Yeah,
those
down
are
about 5%
very,
at the minute.
yeah. So like that's a very tolerable drawdown. There, people, the horror stories, right? We've both heard these, like where people are like, I'm down 60-70% on my account, and I've lost, so much money. And or I had somebody the other day on the stream, they said they had spent $40,000 on prop challenges and had not gotten a payout. And I was like, that is rough. So there's some horror stories out there.
Yeah. I mean, I'm not sure if this is the right time to do it, but there's been accusations against me about I did a streamed a prop firm challenge. It wasn't that long ago. It was late last month. And I saw someone saying I lost 15% of the account. And that's just factually untrue, because this is the account. You can see the date, 22nd of April. I hit the daily loss, which was 4%. These things happen. It's a 4% daily drawdown, especially when I was dollar cost averaging. I was a little bit oversized anyway. It's not a problem in my view. And I wasn't trading for a couple of months because I was meant to move to Asia in April. So I closed my spread betting account and I closed my other account because I had a high risk dollar cost average, which is basically martingale. So I was doubling down every position, but the goal wasn't, I wasn't sending it to my Discord. It wasn't going to my copy trading clients. It was a personal thing. But I did show it on my personal Twitter, but again, it wasn't on my Elite Traders Twitter. I didn't use it for marketing or anything. And that went into, I think it was about 50% drawdown. It might have even been more, but I was up 60%, then had a massive loss on the account. But again, that was completely fine because it was a small account. It's what I was willing to lose, and no one got affected apart from me.
Yeah.
I lost maybe, I think it was about $1,500, $2,000. Again, for me, it's not a problem. I'm quite happy with that.
Right. Yeah, James, so yeah, I had this year a small account challenge that I was doing, like not anywhere publicly. I had a $3,000 account which I know is not a small account, but for me, it was like an aggressive growth account. Now, the stats on that thing looked horrible a couple months ago. With the April sell-off, I basically was long like some very high speculative stocks in this. I was, trading like TQQQ, which is like a triple X leverage on the Nasdaq, and this thing had like a 50% drawdown. So, at that moment, I was like, okay, this account. Now, granted, the account came running back because everything kind of reversed, but that would certainly not meet my criteria for what I actually constitute as, slow and steady trading that I do 99% of the time with what I do. And I didn't share that publicly. So yeah, I mean, that's the thing is you can have these growth challenge accounts and fully accept that these accounts, they could go to zero or they could triple. And, you can only, outline your criteria of your risk. Like with the majority of what I do, it is low risk, slow and steady, not looking to make a ton of percentage per year, but just looking to stack chips year over year. So different approaches. Yeah. I'm also not a prop firm trader. Like I respect people who do that, but prop challenges were not really a big thing when I got into trading, and I never really built my career around them. They've become a big thing in the last few years, but by that time I had already kind of gotten to a point where I did not need any sort of challenges or funding programs in order to have the capital that I need. So, to each their own.
Yeah.
I think that
That's
they're
the
great for certain people, but yeah.
Yeah, it was more of a content thing. Could I pass live? Could I not? What happened? It was a throwaway thing. It wasn't meant to be for anyone to take it seriously. Now I just want to show it because there's been something. So I'm just going to attack not attack. I'm going to go over one last thing because I think that I've not helped myself in a way that I've not really separated myself from elite traders. I've not separated the dollar cost average aspect because I don't do anything in terms of publicity or in public with dollar cost average. I might say I'm short here or shorted there on the streams, but I don't send them to anyone. No one pays me for them because of the risk involved. So these are the types of trades I send. As I said, I've already taken this trade and I'll show that on MetaTrader. And then someone will say, why is this account not attached to my FX book? And I'm going to show that. And this is going to be a little bit difficult for people to just take my word on. So Nick, I'm happy if you want to vet this behind the scenes. I'm completely fine with that. But if I paste my master password in, change the investor code, no matter what I put in here, I cannot change it. And the reason is because it's blocked by Blueberry, because this is the account that is attached to my clients. And the way that's done is because Blueberry have my investor password attached to my client's accounts, and that's how they mirror the positions. So if they didn't lock it and I changed it, it would break the whole system. But again, I know that some people won't understand that or they won't believe me. So Nick, I'm completely happy if you want to vet that behind the scenes, because obviously I don't want to show passwords on screen, or on stream.
Yeah,
but, yeah.
I appreciate it, James. And again, I think that at the end of the day, the big thing here with everybody who's watching as an audience member, we have some people already saying appreciate the transparency. Like that's what matters at the end of the day, is just people who come on here and they share the ups and downs of their trading career. There are things, I'll tell you guys straight up, if I'm doing a high growth trading account, there's a good chance I'm going to blow that thing. Like I'm not, trading gurus will tell you like, oh, I can turn $100 into 10,000 easily. But on this channel, we're all about, practical, slow and steady approaches, and staying real with it. So appreciate that. Appreciate you sharing that, James.
Yeah, no problem. There's one last thing I want to say is that I've never once come onto these streams with the idea of trying to sell anything. So the guys at A1 will put my website in the chat now and again. Never once have I told you to go over to Elite Traders running a massive promo or we're sending new signals. I don't do that because I'm not here to sell things. I come on these streams because I love talking to the chat. I feel like over the past year to year and a half, I built quite a good relationship with them, or at least that's what I thought. And I like to share my ideas on the markets because I feel like that fits with the theme of the not just Nick's channel, but also the A1 branding, because it's very economics based, based on interest rates, real rates, inflation, whatever else it may be. So if anyone feels like I did come here and I've tried to deceive them, I do apologize. That wasn't my intention. And maybe I should have been more clear about what I was doing, but I think the problem I faced was I wasn't really thinking about how it looked. This is my day-to-day life. So when I didn't really see it from an outside view until I saw what people were saying about me. So again, I apologize if that's how I came across, but that really wasn't my intention.
No worries. Don't worry. We love you here, James. You're a crowd favorite. So I got to run. I got to jump onto a podcast here in just a second, James. If you'd like to keep going, you can, but otherwise I think we're going to wrap up the stream. Totally up to you.
Yeah, that's fine. No, okay. I've gone over the charts I'm in, so I think I'll call it a day here as well. So guys, have a good one. And Nick, thank you for having me on. I appreciate it.
Yep. Sounds good. Thanks guys for watching. Have a great rest of your day, and we'll see you next time.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.